All right, let's jump right into this explainer and unpack a truly fascinating financial paradox surrounding Merck right now. Look, if you follow pharma, you already know Merck is an absolute titan. But at this exact moment, it's sitting at the center of one of the most intriguing, high-stakes turnaround stories in the entire market. We're looking at a scenario where the surface numbers completely contradict the underlying market sentiment. Seriously, it's a story of astronomical valuations, a looming patent cliff, and a literal multi-billion-dollar race against the clock. We're coming out of the gate with a glaring contradiction. I mean, how exactly does a company report a massive multi-billion-dollar book loss, yet see its stock surge roughly 60% over 12 months, pushing near its 52-week high? On paper, seeing a GAAP net loss of $5.5 billion for the first half of 2026 is eye-watering. But here's the context. This is largely an on-paper accounting metric driven by a one-time acquisition charge. They aren't just burning cash in a bonfire. The actual operating engine, still humming. Total revenue actually grew 5% year over year to nearly $33 billion. So clearly the market is completely shrugging off the book loss and laser focusing on top-line growth and future potential. But guys, here is the number that will really make your head spin. A trailing PE ratio of 105x. Just let that sink in for a second. 105. For some context here, the broader pharmaceutical industry averages a PE of just 16.6x. So, Merck is trading at a premium that literally dwarfs its peers. When you see a valuation stretched this thin, it tells us one thing for sure. Investors are absolutely not buying the present. They are aggressively pricing in a very specific, wildly optimistic vision of the future. The market is implicitly betting that Merck has a completely bulletproof plan. So let's break this down. Section 1. The threat. The Keytruda patent cliff. This right here reveals a terrifying concentration risk. Keytruda, their absolute powerhouse cancer drug, brings in nearly half of the money coming through Merck stores. In just the first half of 2026, it generated $16.4 billion. That's almost 50% of the company's total revenue. To put that kind of dominance into perspective, if you take the second, third, and fourth largest products in Merck's portfolio and combine them, they don't even add up to half of Keytruda's sales. It was the world's top-selling drug for years. But having half your revenue tied to one single asset with an expiration date, that is a massive fundamental vulnerability. It's kind of like knowing the exact day your winning lottery ticket is going to expire. And breaking this down, that vulnerability is rapidly turning into an active emergency. Merck is staring down a triple threat, and it's all converging right around the year 2028, which, not coincidentally, is when Keytruda's main patents expire. First, you've got biosimilars, generics basically, waiting in the wings to instantly chew out market share. Second, there are persistent headwinds from expanding U.S. Medicare drug price negotiations. But honestly, the most immediate clinical threat? Next-generation competitors. AbbVie just kicked off a massive head-to-head global phase 3 trial against Keytruda. And even scarier for Merck, Akeso's drug, evensimab, already beat Keytruda in a head-to-head trial, showing superior progression-free survival. Patients literally lived longer without their cancer getting worse. Once a competitor beats your golden goose head-to-head like that, your standard of care status is officially on shaky ground. Which brings us to Section 2, the solution, passing the revenue baton. Wow, since 2021, Merck's strategy to fix this has basically been to go shopping. And I mean aggressively. They've nearly quadrupled their late-stage pipeline, mostly by writing massive checks for acquisitions. We're talking $9.2 billion to buy Cidara Therapeutics for an antiviral flu drug, another $6.7 billion handed over to Terns Pharmaceuticals to grab a promising leukemia candidate, which, by the way, totally explains that massive $5.5 billion accounting loss we talked about earlier. Throw in the Rona Pharma for respiratory therapeutics, and the picture becomes crystal clear. Management is effectively trying to buy a $70 billion commercial opportunity to replace Keytruda. They're desperately trying to pass the revenue baton to this newly purchased portfolio. But when we check the actual performance of these supposed savior products, the math gets pretty sobering. Take Winrevair, their new pulmonary arterial hypertension drug. It is doing incredibly well, hitting $1.1 billion in sales for the first half, up a staggering 81% year over year. But despite that explosive growth, get this, it's still only 6.8% the size of Keytruda. Capvaxive and the subcutaneous version of Keytruda, they're just getting off the starting line. Meanwhile, Gardasil, which is a massive established product bringing in over $2 billion, is actually down 9% year over year, mostly because of struggles in the Chinese market. So yeah, the pipeline is definitely growing, but mathematically speaking, filling a $16 billion crater takes a monumental amount of time. Despite that sheer size of the gap they need to fill, the market is definitely finding optimism in a string of recent clinical wins. Back in June 2026, they snagged approval for Lipfindra, the first oral cholesterol-lowering drug of its kind, bumping the stock 3.1%. That very same month, their ulcerative colitis drug, tulisokibart, hit positive phase 3 results for another 5% bump. But the absolute biggest catalyst here is sac-TMT. This drug is advancing through 17 global pivotal phase 3 trials and just scored an FDA priority review voucher. That is essentially a golden ticket for faster regulatory review. With a U.S. launch expected in the first half of 2027, this actually has the scale to reshape lung and breast cancer care standards, especially when used alongside Keytruda. Now, alongside the clinical pipeline, management is actually reorganizing the entire structure of the business to handle this massive transition. They're reportedly splitting their human health business into two totally independent divisions, one purely focused on oncology, which is basically the Keytruda ecosystem, and the other focused on non-oncology. The market reaction to this? Honestly, pretty muted. And it makes sense, right? Restructuring the business definitely makes managing a giant bloated pipeline easier. But as investors quickly pointed out, simply rearranging the furniture doesn't magically print the $16 billion they need to bridge that impending revenue gap. Okay, moving to Section 3, the market tug of war. The bull versus the bear debate. So we have a massive problem, a massive pipeline, and a massive valuation. And this has created a violent split between analysts. In the bull corner, you've got firms like Scotiabank targeting 155. Their argument is that the market hasn't even fully priced in the core pipeline assets yet, especially the massive upside of sac-TMT. But then look at the bear case. Morgan Stanley warns that a 105x PE ratio means the stock is already priced for absolute perfection. They argue that at this insane valuation, pipeline progress actually matters way more than quarterly earnings. If even a single clinical or regulatory milestone disappoints, or, heaven forbid, a biosimilar enters the market early, this stock faces a devastating, violent revaluation. If you're following this turnaround story, you really can't just stare at the stock ticker. You've got to look at the calendar. These right here are the exact clinical and regulatory milestones you need to watch in the immediate future to see who's right, the bulls or the bears. October is going to be incredibly busy. We've got FDA decisions on a Winrevair label update, while a reg for renal cancer and IDXD for small cell lung cancer. But the absolute most critical test to watch, that's the full phase 3 data for tulisokibart. These readouts aren't just updates, they're the ultimate report cards that will prove whether Merck's wildly expensive new pipeline can actually carry the weight. Ultimately, this entire valuation puzzle rests on what we call an optimism premium. Investors are essentially buying a narrative today, crossing their fingers that management's brilliant M&A strategy will perfectly replace that giant Keytruda void. But here is the massive catch. That key assumption, the actual tangible proof that these new drugs can generate $16 billion and fill the gap, well, that won't actually be verified by reality until 2028 or 2029. So as we wrap up this explainer, the final question you really have to ask yourself is this. Are you willing to pay today's astronomical 105x PE multiple for a transformation that might not completely materialize for another 3 years? Merck definitely has 20-plus blockbuster potential assets and some incredible acquisition capabilities, but they also have half of their revenue tied to a drug with a ticking clock. It is the ultimate high-stakes waiting game, and the next few clinical readouts are going to be the very first clues to how this story ends. So keep a close eye on those data releases, and we'll see how it all plays out.